I want you to picture something for a moment. A massive cargo ship, hundreds of thousands of tons of crude oil, sitting dead in the water in one of the most strategically critical waterways on Earth, the Strait of Hormuz. The captain gets the message: pay the toll in crypto to proceed. He pulls up Bitcoin, and then he waits. 1 hour, 2 hours. The crew is restless. The oil cargo is losing value by the minute. Other ships are backing up behind him. The geopolitical situation is deteriorating by the hour. And somewhere on a server in the Middle East, a Bitcoin transaction is still pending. This is not a hypothetical. This is what would have happened if Iran's decision to charge crypto tolls at the Strait of Hormuz had been denominated in Bitcoin. It wasn't hypothetical. It was policy. And the asset that actually works for that transaction, the one that settles in 3 to 5 seconds instead of 1 hour, has been in your portfolio the entire time. Iran just accidentally ran the world's most expensive XRP commercial, and almost nobody noticed. Welcome back to XRP News Flow Signals, where we find the signal in places most channels never look, including geopolitical crises. This is not financial advice. Always do your own research. But if you want to understand why the Strait of Hormuz story this week is one of the clearest real-world demonstrations of XRP's utility ever documented, stay with me. This one connects fast. Let's start with the hard truth that most crypto coverage of this story completely missed. When Iran announced it was charging ships crypto tolls to pass the Strait of Hormuz, the immediate reaction from large parts of the crypto community was, must be Bitcoin. That assumption was made in less than a second. No analysis, no thought about what the transaction actually requires, just reflex. Let's run the actual requirements for a crypto toll at the Strait of Hormuz. A ship approaches, the toll demand is issued. Payment must be confirmed before the vessel is permitted to pass. In a geopolitically volatile waterway where every minute of delay has measurable economic consequences, where oil cargoes are losing value, where the geopolitical situation can deteriorate between 1 hour and the next, the settlement window is not a minor operational detail. It is the entire architecture of whether the system works. Bitcoin, approximately 60 minutes per transaction confirmation under normal network conditions. Under high-load conditions, longer. XRP, 3 to 5 seconds. Finality. Done. A ship paying a Bitcoin toll at the Strait of Hormuz would sit dead in the water for up to an hour, waiting for confirmation. In a waterway that closed again within 24 hours of a ceasefire agreement, a waterway where the geopolitical situation can reverse faster than a Bitcoin transaction confirms, that settlement window is not a friction point. It is a structural impossibility. Now, here is the detail that makes this story even more remarkable. There exists an organization called Spend the Bits, whose entire purpose is to tokenize Bitcoin so it can be transacted across the XRP Ledger. Bitcoin, the asset that Bitcoin maximalists insist is the only serious digital currency, requires a wrapper that runs on XRP rails to function as a practical payment instrument. The infrastructure XRP's community built is so superior for actual transaction purposes that even Bitcoin's use cases are being routed through it. That is not a debate point. That is a documented operational reality that has existed since Chris Larsen demonstrated Bitcoin transactions on the XRP Ledger back in 2014. Bitcoin's future is as a tokenized store of value asset running across faster networks. The network it runs across most naturally already exists. And Iran's toll policy, however briefly it was implemented before the strait closed again, just put that reality in front of every geopolitical analyst, every treasury manager, and every shipping company in the world simultaneously. Now, let's run the numbers that the Hormuz story puts in sharp relief, because the real-world demonstration connects directly to data that hit the market this same week. On the same day that Middle East uncertainty was pushing oil to $97 per barrel and creating exactly the kind of macro noise that keeps retail investors sidelined, XRP ETFs recorded a $3.32 million net inflow. Let's put that in context. Bitcoin spot ETFs, $159 million in outflows. Ethereum spot ETFs, $64.7 million in outflows. Solana spot ETFs, $15.4 million in outflows. Every major crypto ETF product lost capital on the same day that XRP ETFs gained it. XRP stood alone with positive inflows on one of the most geopolitically turbulent days of the quarter. That is not a coincidence produced by retail sentiment. Retail investors do not systematically allocate into ETFs during macro uncertainty while simultaneously pulling out of Bitcoin and Ethereum. That is institutional allocation behavior, methodical, pre-planned, and indifferent to the daily noise that moves retail positioning. Now add the on-chain signal reported on April 4th. Market analysts documented that major institutions have been silently accumulating over $200 million in direct XRP holdings, not ETF exposure, actual XRP on balance sheets. The distinction matters enormously. An institution that buys an XRP ETF is gaining price exposure. An institution that holds actual XRP is positioning for utility. They are not buying the performance of XRP. They are buying the instrument itself, the asset they will use to move capital across corridors, settle payments, and operate on the XRP Ledger directly. Think about the logic of that distinction. If you are a corporate treasury planning to use XRP for cross-border payments to overseas suppliers, you do not buy an ETF. You hold the asset, because the ETF cannot move money to your distributor in Singapore in 4 seconds. The XRP in your wallet can. The institutions buying actual XRP right now are not speculating. They are pre-positioning operational capital. And here is the supply math behind that positioning. Every XRP moved into institutional cold storage or direct balance sheet holdings is XRP removed from exchange liquidity. ETF inflows do the same thing. XRP purchased to back ETF shares exits the tradable float. As that supply tightens against a market where 50% plus of circulating supply is already an unrealized loss, meaning those holders will not sell at current prices, the available liquid supply for new institutional demand is narrowing. The Hormuz story illustrated the utility. The ETF data confirmed the institutional direction. The accumulation signal showed the positioning, all three in the same week. Let's talk about what 2026 represents structurally, because the individual data points this week only make sense inside the larger frame. For every previous crypto market cycle, the primary fuel was retail capital. Individual investors discovering crypto, allocating discretionary savings, chasing price momentum. The parabolic runs of 2017 and 2021 were retail-driven events. The collapses that followed were retail-driven events. Panic selling, leverage liquidations, sentiment reversals. 2026 is structurally different for one reason. Institutional capital is entering for the first time at scale. Not exploring, not piloting, not allocating a small percentage to a digital asset research budget. Allocating through regulated ETF products, through direct balance sheet holdings, through treasury management platforms, through payment infrastructure integrations. The numbers quantify the difference. Retail capital in previous cycles moved billions into crypto at peak sentiment. The institutional capital pools now evaluating XRP allocation are measured in hundreds of billions to trillions. Sovereign wealth funds, pension systems, corporate treasuries, family offices with compliance-grade mandates that require the regulatory clarity XRP already holds. When that capital deploys at scale, the comparison to retail-driven cycles is not instructive. The scale is categorically different. And the Hormuz story adds a dimension that pure financial analysis cannot capture: geopolitical proof of concept. Every shipping company, every energy trader, every logistics operation that watched the Strait of Hormuz toll story this week learned something specific about digital assets and settlement speed. Not from a white paper, not from a conference keynote. from a live geopolitical event that demonstrated in real time why settlement speed is not a technical specification. It is the difference between a system that works and one that doesn't. The Fear and Greed Index returning to neutral this week is a retail signal. It means the emotional extremes that drive retail decision-making have stabilized. What it does not capture is the institutional allocation cycle running underneath retail sentiment, methodical, quarterly, compliance-driven, and indifferent to whether the Fear and Greed Index reads 45 or 65. The institutions allocating to XRP right now are not checking the Fear and Greed Index. They are executing against deployment timelines set months ago. The retail confirmation event, the green candles, the mainstream coverage, the FOMO, comes after those deployment timelines complete, not before. I want to pause here because the Hormuz story, the ETF inflow data, the 200 million silent accumulation, and the 2026 institutional frame are four separate signals that only make sense when you read them together as a single picture. That kind of cross-signal mapping, from geopolitical events to on-chain data, to ETF flows, to institutional positioning, is exactly what XRP News Flow Signals is built to deliver. Subscribe right now and turn on notifications, because the next leg of this institutional cycle is going to produce specific, datable events, and the window between those events landing and the price reflecting them is the only window that has ever mattered. This channel keeps you inside that window. Let's be precise about what the convergence ahead looks like, because the signals this week are not isolated. They are part of a visible, sequential deployment cycle. Catalyst 1, Strait of Hormuz resolution. The waterway closed again within 24 hours of the ceasefire. Every day of uncertainty keeps oil elevated and macro-sensitive capital sidelined. When the geopolitical situation stabilizes, when the ceasefire holds and oil begins its pullback from $97, the capital currently sitting on the sidelines has its confirmation signal. Historically, sidelined capital does not re-enter gradually. It rotates fast. Catalyst 2, ETF inflow continuation. XRP ETFs recorded positive inflows on one of the most difficult macro days of the quarter. If that pattern holds during the next leg of macro uncertainty, if XRP continues to attract institutional ETF allocation while Bitcoin, Ethereum, and Solana bleed, the data tells a story about structural demand that the price has not yet reflected. Catalyst 3, $200 million plus accumulation becoming visible. Institutional direct XRP holdings are not announced. They appear in custody data, in on-chain wallet behavior, in exchange reserve drain patterns. As the $200 million plus accumulation documented on April 4th continues to grow, the on-chain signal tightens the available liquid supply against incoming demand. Catalyst 4, triangle breakout confirmation. Technical structure shows the breakout pattern already forming. The trigger is not a chart event. It is a real-world event that confirms the macro environment has shifted. The chart is already positioned. The catalyst is the news. Here is the supply picture that makes the catalyst timeline structurally significant. ETF inflows remove XRP from the tradable float. Direct institutional accumulation removes XRP from exchange liquidity. The 50% plus of circulating supply sitting in unrealized loss stays locked. Those holders will not sell at current prices into a market that has not yet confirmed the breakout. 3 separate supply compression mechanisms running simultaneously against a demand picture that just showed positive ETF inflows on the worst macro day of the quarter. The Strait of Hormuz demonstrated why XRP works for real-world transactions. The ETF data confirmed institutions are acting on that reality. The price has not caught up yet. That gap is the signal. Let me leave you with the frame that ties all of it together. Iran charged ships crypto tolls. The settlement requirements made Bitcoin physically unworkable. The asset that settles in 3 to 5 seconds, the one that even Bitcoin is tokenized onto to function as a payment instrument, has been in your portfolio the entire time. On the same day that geopolitical noise pushed every major crypto ETF into outflows, XRP ETFs recorded net inflows alone, while institutions quietly accumulated $200 million in direct holdings on the other side of the retail sentiment screen. The Fear and Greed Index says neutral. The on-chain data says accumulation. The ETF flows say institutional preference. The Hormuz story says real-world utility proof. These are not 4 separate stories, and it is the clearest signal this channel has mapped in months. If this breakdown connected the dots you have been watching separately, subscribe to XRP News Flow Signals before the next macro shift lands. The triangle is already broken. The institutions are already positioned. The catalyst is a new cycle away. You want the analytical framework already built when it arrives. Drop one word below: Hormuz, if the Iran story reframed how you see XRP's utility case. Let's see who caught this signal. Stay sharp. The signal does not lie. Not financial advice. Always conduct your own research.